Hello there. There is no doubt the pandemic has been an inflection point for the banking world. It supercharged digitalization. What would have taken years took only months. The thing is, customer expectations of banking have also risen significantly. So, what's been the impact of COVID-19 on the agenda of banks? What are the key areas for digital bank success? Well, we have the perfect person to address all these issues. Piyush Gupta of DBS. DBS, by the way, the largest bank in Southeast Asia, a region of 600 million people. Euromoney named DBS the world's best bank in 2019. Harvard Business Review ranked DBS among the 10 most transformative organizations of the decade. And Piyush himself was named the 100 best performing CEOs in the world, a great believer in digitalization long before it became the buzzword. Piyush, always good to have you with us.
Happy to join you, Haslinda.
Now, Piyush, what's fundamentally changed in the way banking is done, in the way banking is run, and in the way we view the future of banking since COVID-19?
Well, Haslinda, I'm going to actually take a quick second to talk about some cyclical impacts of COVID-19 because I do think they have a little bit of bearing. And those cyclical impacts are obviously, there's been a huge amount of demand destruction. As a consequence, you expect to see large amount of non-performing loans and credit costs are going up. Equally, as a consequence, monetary policy eased, and so interest rates have collapsed. Now, why do I think this is germane? Obviously, for banks, you've got to focus on these things in the short term. But I do think that these things will also push the banks to thinking very differently about what their future business models are and what they need to be doing. If a net interest margin and interest income is more challenging, you have to start thinking about very different opportunities and avenues for growth. And if credit continues to be challenging, then you're going to have to think about other ways of underwriting and other forms of managing your portfolio, including digital and data and so on. So just a quick reflection that even the cyclical impacts of COVID have some bearing on where the industry is going. But more fundamentally, in a secular way, I'd say the three things that have been important on the back of COVID. One, as you alluded to, the take-up of consumption of everything, whether it's healthcare services or education services, has just skyrocketed. And certainly in our industry, the take-up of financial services electronically, digital consumption, has indeed grown at an exponential pace. I was just looking at our data. Our total growth in whether it's electronic payments or electronic collections or a whole range of interactivity with the customers went up well over 100% in the course of last year. And what was particularly interesting was this was not age specific. In the past, we'd expect the younger kids, the younger generation, to take to digital products and tools quickly. Well, the fastest growing segment we saw last year was the people who are 60 plus. We saw a 4x increase in their take-up of digital tools and digital payments. And so the broad-based nature of consumption in the consumer space was quite apparent. What was equally interesting was the rapid change in corporate behavior. And that includes particularly small and medium enterprises. Many companies who we've been trying to encourage to move to electronic banking and electronic channels over the years, and they've not been that confident and comfortable doing it. They didn't have a choice. When you had to get a letter of credit open or apply for a loan or open the next banking account, banks would only let you do that electronically. So that shift has been rapid. And even in the large corporate space, the number of companies who've gone and reimagined and rethought their own supply chains down the spectrum, that's also changed very materially. We're actively involved right now in a range of supply chains and wiring up connectivity, whether it's from the auto industry or the metals and mining industry or just large commodities players. Lots of people have had to seriously invest dollars and thinking on how do you do this thing very, very differently. Now, all of this, of course, means that for banks who are equipped to do that, it has been a bonanza. We've been able to actually get greater customer access and therefore improve market share quite considerably. But it also means that the banks who had not actually invested in this in the past didn't have a choice. They had a gun to their head. And so it has accelerated the investment of even the slower banks in this space. So in some ways, there's been a bit of a catch-up all around. I think some of these impacts and effects are going to be long-lasting. So you said inflection point. I think that is indeed true. There is a bit of an inflection point. A second way that has changed, frankly, every industry, but also banks, is our way of working. So if you'd asked me a year ago that we could imagine a situation where 95% of our people worked from home or remotely, I would have said highly unlikely in our industry. But guess what? Depending on the country and the situation, we've had anything from 50 to 80, 90% of the people work from home for the better part of a year. Now, this, of course, has profound implications on the nature of our work practices. What do we do going forward? And it's not just simply who comes into office. Do you change the nature of the office? Do you shrink your footprint, commercial footprint? It is also more important questions about where do you source your people? Where do you locate your people? People talk about just in case versus just in time. I don't think that's true just for the manufacturing industries. It is equally true now for service industries in our sectors. We're thinking about where to locate our technology resources, where to put our engineering resources quite differently. So I think it's going to have some profound implications on how work gets done. And I think the third...
You talked about how... Go ahead.
Go ahead. Well, I don't want to
I was going to say that
too long. Just quickly, very briefly, I do think also there's been a turbocharging of the focus on the ESG agenda because I think there's a recognition that tail risks happen and we better be prepared for them. And a large part of this ESG agenda actually also benefits from a digital solution set. And therefore, that's the third thing which I think is going to change quite materially.
You talked about how the non-believers also had to get on the digital bandwagon. Everyone has a digital strategy now. The laggards have played catch up. So what next for competitive edge? Which technology, which digital technology will give you the biggest payoff? Who will lead the pack? And for a bank like DBS, which was ahead of the game, what does it mean?
Well, Haslinda, first of all, while digitizing, I think, is now table stakes, I think the quality of your digital effort can still make a difference. If you've really thought customer-centric and thought through customer journeys, you will find that there is a lot more you can do. And if your technology stack has already evolved to what I call a modern technology stack, you have a lot more flexibility to do more things. So the fact that we have 1,000 APIs open for our products to the consumer space, that means we can plug into supply chains, we can plug into SMEs, and we can plug into ecosystems far more readily and swiftly than many other competitors can. So I think even in the nature of digitization, you can actually retain a competitive edge. However, I think the real game changers and differentiators over the next 5 years are going to be data and artificial intelligence. Your capacity to harness data and use data smartly and intelligently is going to make a big difference. Now, this obviously is not easy. You need to have the technology. You need to change the mindset of the company. You need to build in a whole architecture of responsible use of data to make sure you're not, doing the wrong things with data, etc. So this is a multi-year journey. And I think focus on this, which we've been at for the last several years, should allow you to, stay ahead of the game. A third area where I think you will see changes is blockchain and distributed ledger technology is really beginning to hit tipping point. And while 3, 4, 5 years ago, I used to be skeptical about public blockchains because of the need to get exponential adoption, today I'm seeing more and more use cases where you can create walled blockchains. We're already doing some stuff on the currency space. We're doing some stuff in trade finance. So I think some of these modern technologies will also allow you to move forward. One thing I think you'll see a lot of this year is just the rollout of 5G and the Internet of Things. And if you're cutting edge, you will be able to do a lot more things today, even with those kinds of technologies, than you could do before. So in short, technology keeps evolving. If you have the nimbleness and the innovative capacity to leverage the new technologies, I think you can continue to hold your own. Piyush,
DBS has gone to market with its new digital currency exchange. the first major bank to do that, and that's to meet the rising demand for cryptocurrencies. What's the first mover advantage? What are the first mover risks?
Haslinda, we're actually trying to do three things with the digital exchange. The first is to be able to tokenize a whole range of physical assets and actually allow listings, whether the securities token offerings for debt or for equity. I think that's a huge positive because I genuinely believe that you will see a mass-scale tokenization of many kinds of assets, not just financial assets, but non-financial assets as well. And therefore, having the capacity to tokenize, but more importantly, to list and then trade is quite helpful. You think about private capital, all the companies sitting on Series A, Series B, and Series C funding, there is no liquidity in these rounds, and so investors are stuck. If we can create a private capability for people to monetize and provide liquidity to some of these asset classes, I think that's a good thing. The second offering that we're offering is effectively to be able to trade cryptocurrency. And to be fair, that offering is only for accredited investors. It's on a members-only basis because there are a lot of risks in dealing with cryptocurrency, especially for the uninformed investor. You could argue that a lot of it is not backed by fundamentals. However, for people who are willing to believe that Bitcoin could be the new gold, we want to create a venue and an opportunity to be able to buy and sell that from a respected, regulated entity like ourselves. The third part of our offering is a custody capability. You know, most of the hacking that happened over the years with crypto coins, etc., happened in exchanges. Our belief is that if you can actually hold the custody inside of a regulated entity like a bank, that would make it very differentiated to other kinds of offerings. Our belief is basically, therefore, there are a lot of first mover advantages. If you go in early, you establish credibility, you do a lot of what it takes to be a bank, anti-money laundering, KYC, controls, protocols. You will build trust, and you should hopefully be able to build the liquidity into the exchange. Now, what is the first mover negatives in something like this? Obviously, nobody knows what they don't know. And so while we've been very, very thoughtful about architecting a solution set that we think meets all of today's pain points, as well as we're making sure that we do the right thing from a control and risk standpoint, there could always be something that we have missed. You know, that is the downside. As a consequence, we are being quite thoughtful about the pace at which we're scaling this up. Like I said, it's going to be for accredited investors in the first place, and it's going to be by invitation, a members-only exchange. So we will learn as we go along and open it up to other kinds of populations only when we're ready.
And the thing is, when you take a look at Bitcoin, parabolic surge, massive volatility, I mean, you can understand why governments are pretty much split down the middle when it comes to cryptocurrencies, to Bitcoin. I mean, Singapore and Hong Kong, they're split on cryptocurrencies. I mean, what do you make of what we can expect in terms of regulation, maybe, I don't know, 3-5 years down the road?
I think that's a broad question. My general view is that sooner or later, you will get to a stage where people are all dealing in digital currency. Now, whether the digital currency is issued by a private third party or issued by a central bank is less important. The fact is that, by and large, I think you're getting to the end of cash. You already see that in China. And you go with physical notes in China, you can't buy a thing. It's all effectively digitized. I don't think you'll get entirely cashless because there are people who still want to use cash for privacy and transactions, for inclusion. But broadly speaking, I think you're going there. Now, if you get to a world then where digital currencies are accepted, and whether it's a central bank digital currency or otherwise, then you're already getting to the space where most central banks will start embracing and putting around regulation and control to allowing people to hold it and deal with it. If it's central bank issued, it will be a unit of exchange, a medium of exchange unit of account, as well as store of value. If it is privately issued, depending on how well it's adopted, it might only be a store of value, and that depends on confidence it has. It might not wind up being a medium of exchange or a unit of account. But if you look at the different natures of money, I think digital currencies will start playing a bigger and bigger role. Now, if you look at Singapore, the MES has been very constructive about thinking about digital currencies, distributed ledger technology. We participated in a whole exercise called Project Ubin in Singapore to see how we could use the distributed ledger to actually transfer digital currencies onshore. We are now just leading off an international cross-border project along with another international bank in Temasek to be able to run digital currencies in the cross-border space. And the central bank has been quite supportive of our doing this. The Central Bank of China is actually quite active in trying to pursue this as well. So I think you will find slowly that many central banks, with controls and with some thought, will actually be supportive of this direction.
Piyush, I want to talk about geopolitics because rising tensions pretty much define 2020. The pandemic has accelerated that somewhat. U.S.-China bifurcation, nothing more apparent than in the tech space. But that tech bifurcation isn't going anywhere, is it, even with a Biden administration? What's your take on that?
Well, I think to a large extent you're right. The concerns around China in the US have been bipartisan on both sides of the aisle. So it's not clear to me that a Democratic government would be any lighter on China than a Republican government. In fact, historically, the Democrats have always been more principle bound. So issues around human rights and IP protection are more central to their agenda. And therefore, I don't expect any substantive pullback in the nature of the underlying issues and perhaps even the approach of dealing with them. However, where I think you will see a change, and that change is very material, Haslinda, is in the quality of the dialogue and the tenor of the dialogue. So if the conversations are more civil, if you have more adult conversations, if they follow norms, and if there's a coalition of interests and platforms for negotiation, I think that will lower the heat. And part of the big challenge you've seen in Asia, in fact, around the world the last year, has been the challenge of uncertainty, the mercurial nature of the toing and froing. Now, if you take that out of the equation, and if there's clarity and line of sight to where people are trying to go, that actually does a lot for animal spirits and does a lot for creating market confidence. And therefore, while I don't think there'll be substantive change in the underlying, I think there will be a meaningful change in the nature of the engagement and therefore the way the market responds to it.
How do you view U.S.-China relations, given that DBS has significant operations in Hong Kong, does business in China? Because in the final days of the Trump administration, we saw how the U.S. restricted the sale of U.S. technology to Huawei and other firms. Investors were forced to pull out of companies linked to China's military. Companies were blacklisted. I mean, how do you put that in perspective as a company doing business in cities and countries with a lot of Chinese presence?
Well, it's tricky for us, but as you can imagine, it's tricky for all of the nation states in Asia. If you take Singapore, for example, we like to play squarely between China and the US. We rely on the US for a lot of our defense and political connectivity and connections. And China is our biggest market. It's our biggest supply and trading partner. And so there is, every need and necessity for us to make sure that we stay neutral and play to both sides. Now, sometimes it's easy to do, sometimes it's a lot more difficult to do. I think a regime and an environment where dialogue is encouraged and you have, like I said, civilized and adult conversations makes it somewhat easier. Some of the steps taken by the US administration in the last several months, if you ask me, have actually been Pyrrhic in a way. So you take all of the import tariffs. At the end of the day, the sum total of the import tariffs has still wound up in a situation where China's trade surplus with the US has only grown, it's not reduced. So it's not clear what you've been able to achieve when you did that, as an example. Or you take a policy which prevents Chinese companies from listing in the US. Well, at the end of the day, if you want New York to be the thriving capital market, then surely you want more companies to come and access the capital markets as opposed to keep them out. So I think as you go forward, if some of these, what I call Pyrrhic or counterproductive policies are, moderated, I think that will be helpful and easier for people and countries who are sitting in the middle of this game to be able to calibrate and, be able to work equally with both sides.
Piyush, as we look at the year ahead, what do you view as the biggest risk and what do you view as the biggest hope?
Well, I think the epidemiological issues around the pandemic are still out there, uncertain. I think the biggest hope is quite clearly that the vaccines pull us through this very quickly, and so you see steep economic rebounds all over. But not entirely clear if you're vaccinated, are you still a carrier? How long do the antibodies last, etc.? So there is one set of issues around that. I think a second bigger set of issues, though, is at a societal level. Uh, Over the last decade, the issue of inequity, income inequality, the 1% versus 99%, has continued to become more and more important to people. But the pandemic really brought it to the forefront. The people who were in the top 10, 20%, who had financial assets and could benefit from easy monetary policy and rising financial markets, have done relatively okay. The people who had to go out of the houses did have to go to work, the blue-collar workers, the department store, cash register operator, etc., who are working on a daily wage, were not able to do okay. I think this tension is going to be one of the biggest tensions in the next few years. And particularly this year, as several governments have to willy-nilly wind back some of the support programs, wind back the largest they gave to both individuals, households, and small companies, I think this tension is going to come to head. And therefore, how do we negotiate through this over the next year or two, or perhaps even the decade, I think is going to be a big source of risk. And finally, the third risk, I talked about it briefly. I think, again, it's been quite clear for the last decade even that the issues around sustainability, environmental sustainability, both climate and biodiversity, are beginning to be very serious. I think the pandemic has made it quite clear you can't afford to ignore them, because when something happens, which is a tail event, the consequences are quite catastrophic. And therefore, thinking hard about some of these, what do we want to do to get to being a less carbon consumptive society? What do we do about the biodiversity loss that we're seeing? I think that's another big risk that will be quite at the forefront of people's thinking and minds over the next several months and years.